It is not what you earn, but what you keep. This old saying is even more important now today. We want to pay as little in taxes as possible. And in this video, I will share with you some of the important year-end tax planning tips you might want to consider. Hi, I'm Mark Singer, founder of Your Retirement Authority. And for up-to-date and timely information about retirement, retirement income, Social Security, click on the link below, subscribe to the channel, and hit the notifications bell so you know when we're posting new videos. If you've been watching my channel, you know that I harp on all the time that in retirement, cash is king. It provides you with the freedom, the confidence to go pursue whatever your retirement dreams are in this next chapter of life. And I always talk about planning and how important that is as well. So you need to start off with, and I say it over and over again, a cash flow worksheet to understand what you need, where it's coming from, and where you're going to get the balance of the income necessary to pursue your goals. And one of the big things, one of the big mistakes I find that people make when doing their own cash flow worksheets is they forget one crucial element. They understand what they're going to spend, but they don't understand that for the most part, they need to gross up that amount for taxes. They often don't remember that they have to pay taxes on the income they're getting. So we're going to focus on some of those items today. I've got 5 major things that you should be aware of with regards to year-end tax planning. So the first thing I want to share with you is looking at the possibility of doing a Roth conversion. And when it comes to all the planning I'm going to share with you today, it's important for you to consult with your tax and or financial advisor before you do anything. Just don't rely on what I say here. You have to take into consideration what your goals are, what you need in terms of this next chapter of life for you, and potentially the chapter of life without you, beyond you, for your legacy, for your spouse, for your children and grandchildren. So let's talk for a moment about what is a Roth. So a Roth is similar to an IRA in that it can grow tax deferred, but the big benefit is there's no required minimum distribution for those of you who are looking at retirement versus the IRA, which has a required minimum distribution now at the age of 72. It used to be 70 and a half, and now it's 72. And you have to take out somewhere in the vicinity of about 3.5% of the amount of money that's in your total pool of IRAs in terms of required minimum distribution in that first year. Now, it sounds great, isn't it? But there's always a string attached, right? So if you contribute to or convert an IRA into a Roth, there's a tax consequence for that. You need to be aware of that up front. Any money that you do convert over will be a part of your income for the year that you make that conversion. So you'll have to have some money, some liquidity to pay for the tax associated with converting the money or a part of the money that you have in your IRA over to a Roth. Now the question becomes, why would I do that? Why would I incur some current tax liability in order to move money from my IRA to my Roth? And one reason may be, and as I talk to my clients, just to reduce the amount of required minimum distributions depending upon your situation. Or for some of my clients, we actually can carve out a particular IRA for the benefit of their kids or grandkids. So depending upon the size of the estate they have or the amount of money in their retirement accounts, and depending upon how much income they need, it may be a very good idea to do a Roth conversion because you may not need the income from that IRA now or in the near future. And again, you may be able to have quite a benefit for your non-spousal beneficiaries. We'll get into that in just a moment, down the road when you're gone. So there are good reasons to do it. There is a reason to make the conversion now, and I want to get into that in a little bit more detail right now. Now, there are a couple of things you need to understand in terms of big picture items that are converging right now that you need to understand, all right? First, these low tax rates. These are historically low tax rates, and regardless of what happens, in the next administration, the trend is more than likely going to be that tax rates are going to go up. And they were going to go up before the pandemic hit and before this new administration is going to be in place. But you also have to understand the second item which is the pandemic did hit, and we are having to create economic stimulus for many people that is in the range of trillions of dollars of debt that will have to be paid later on. And there's one way that our society is going to repay that debt, and that is in the form of higher taxes. And they can come in many different forms for many different people. But again, right now, we're not having to pay at the moment the trillions of dollars in debt, and taxes are at their lowest relative to what it will be looking forward. So now really is a good time to take a serious look at a Roth conversion. Now, I talk with a lot of CPAs about this, and many say, listen, the benefit is in the future, and you're going to pay a little bit of money right now. So if you do the conversion now, make sure you do have liquidity or funds available to pay the tax. But the CPAs often say, listen, I don't want my client to pay that tax right now for some future benefit that may be available either to them or to their kids later down the road. But I would submit to you to really push them to find out what the long-term benefit to you would be over time. I think oftentimes it will be in your favor if you really understand that you can, by moving money from your own IRA into a Roth, can also reduce the amount of money that you need to take out for your required minimum distribution. Because again, the Roth doesn't have a required minimum distribution. So you want to really ask that important question about not only what is the cost today, but what is the benefit down the road. Make sure that you have funds available right now. And one of the things that's really important, and this changed back in 2018, you used to be able to create a Roth and do what they call a recharacterization and go, sort of like in golf, a mulligan. Oh, never mind, I didn't really want to do that. Well, you can no longer do that. So now it's an irrevocable decision to make. If once you go down that road, you have to stay there. So get well informed and give your accountant or your tax advisor a call now to see whether or not it makes sense, based on your planning, whether a Roth conversion can work for you. Remember that by doing a conversion, if it works for you, you're taking out a great risk and uncertainty. And that uncertainty is that, in essence, if the tax rates go higher later, you've taken advantage of them now. And monies that come out of your IRAs later will probably be taxed at higher rates. So put that into the calculation when you talk to your tax advisor or your financial advisor about the potential for you of converting to a Roth IRA. The number 2 tax tip that I want to share with you is with regards to your IRA distributions. Now, the CARES Act, which was enacted this year in 2020 in response to the coronavirus, that's the C in CARES, indicated that those who were going to be taking out required minimum distributions because they had achieved the age of 72 did not have to for this year alone. We don't know looking forward whether or not that will be maintained for 2021. I'm going to assume it's not going to be moved forward, but if it is, that's great. But for 2020, you did not have to take out your required minimum distribution. Now, the key was to understand from a cash flow perspective whether you needed it. And we went back to all of our clients and said, listen, this just came out. It's something that we can consider. Let's see whether or not it makes sense to either eliminate the required minimum distribution or figure out where in other personal or taxable accounts to take the money from so that you can get the same income but reduce the amount of taxes. In other words, if you were taking X amount out from an IRA, it was going to be fully taxed at your existing marginal tax bracket. But if we could shift that over to a personal or taxable account, more than likely the taxes owed on that money coming out were going to be less. Now, there is a lot of discussion around what is going to happen with tax rates, and as we look at it, a lot may depend upon what the makeup of the Senate is going to be and whether or not the Democrats will have the ability to move forward in a more accelerated manner tax increases. You may want to actually take advantage of these low tax rates and bring more money out this year rather than waiting next year or the year after that when tax rates might go up and have more of your money taxed at a higher rate. So again, this gets back to the planning of it with regards to what your objectives are and what your goals are. And it's the intricacies and the fine details of retirement planning that you need to be taking a look at. It's not just accumulation of money, right? At this point, when you've reached your retirement, money management sort of goes on the back burner in a sense. It's no longer that big, important conversation you were having when you were in the accumulation stage of things and you were working and you wanted to develop that nest egg. Now that you have that nest egg, you want to make sure that you maintain that nest egg so it can deliver the income that you need in the most tax efficient manner possible. And that's why you should really take a look at whether or not you want to have more money distributed this year from your IRAs and take a look at the bigger picture. Now, one thing to consider with regards to planning and the required minimum distributions, many of my clients don't necessarily need all or any of the money coming out of their IRAs, but the IRS says they have to take it out. So from a planning perspective, if you've got other considerations, if you're looking at gifting, if you're looking at one item we talk about a lot with our clients is long-term care insurance, you may want to look at your required minimum distribution as a way, as liquidity and funding for the gifting or the long-term care insurance. So if you don't need the money, but it has to come out, then I would think about it from a planning perspective in terms of earmarking that money for a particular purpose or goal. You may have a bucket list item that you want to spend it on, or some, joy of the journey item. Or again, like my clients, take a look at it from gifting or funding for that long-term care insurance bill. So there's a lot of different ways to take a look at the required minimum distributions. And again, it all begs the question of, have you done the proper planning? And this is where I talk about in our masterclass doing all of that planning. So if you're interested in getting a more in-depth understanding about how planning can help you, make sure that you click on our masterclass to learn more. The third item of the 5 that I want to talk to you about with regards to year-end tax planning is qualified charitable distributions. This may be the most tax-efficient way to provide for that gifting that you might want to consider at this stage of life, but it's not available to everyone. Now, what's interesting is with required minimum distributions and the QCDs, or the qualified charitable distribution, it used to be if you attain the age of 70 and a half for both the required minimum distribution and for the QCD, that you could initiate both of those. You could use the required minimum distribution to fund an institution. I get that question from my clients all the time. I went to a particular college, university, and I'd like to start giving back. How can I do that? I'd like to take some money from the retirement account. And they can do the QCD. They can take a part or all of that required minimum distribution, have it go directly to the charitable institution. And at the age of 70 and a half, it was all kicked off. But things have changed a little bit. Now with the new CARES Act and the SECURE Act, the required minimum distribution from the SECURE Act has been raised to 72. However, they did not raise the age for the qualified charitable distributions. And you can still do, at age 70 and a half, a qualified charitable distribution directly from the IRA to your financial institution. The limit is $100,000 per owner, not per every IRA you have, but you can do up to $100,000 in terms of a gift annually to the qualified institution. So check with your tax advisor about whether or not this makes sense for you to do that. And again, keep in mind the overall planning. If you do gift $10, $50, $100,000 to the charitable institution, to that qualified institution, how will that gifting impact you on a current or future basis in terms of the income you need? So you need to keep all of that into consideration. And again, why planning is so important. And speaking of planning, big topic of conversation for my clients is now, and it's the fourth tax planning year-end technique I would share with you, is the whole topic of gifting. And I will share with you the conversation we have with our clients all the time. They come in and they go, listen, I want to gift $25, $50, $100, $200,000 to my son or daughter, or to buy the house that they want, or help with the grandkids, education, whatever it is. And my response to them always is, listen, you are my client. And I know that you want to help out your kids just like I want to help out mine. But we have to make sure before we give that money away that it won't have an impact on our ability to pursue our goals. So the planning is real important because you can put into a plan, into the retirement roadmap, hey, listen, I want to gift $50,000 or $200,000 away. What impact will that have before I actually go about and do it? So let's get into the gifting conversation for just a moment. Right now, the gift or estate tax exemption is $11.58 million for an individual, or for a couple, a little over $23 million. So that's the exemption that you have, and that will be changing in 2025 to $5 million for an individual and $10 million for a couple. But one of the things you have to recognize now, again, I talked about those two items that are converging right now, low tax rates and the debt that we're now going to have to fund. And how are we going to fund it? It's going to be funded through taxes. And one thing, one element, one item that Congress can use to bring in more money is taxes and changing existing laws. And it may very well be that we could be changing the estate tax, death tax exemption before 2025, because when this was instituted, we didn't have a coronavirus economic stimulus debt of trillions of dollars. But now we do, and that may end up being even more so. So Congress may be pushed to finding alternative ways to come up with taxes in alternative places, and they may accelerate the reduction of that estate death tax exemption as a result of the debt that we own. So it may be important, as you talk to your estate planning attorney and your financial advisor, to see if whether or not accelerating the gifting now makes sense for you, and if you're married, for your spouse. There are 3 tiers of gifting available. The first is a $15,000 annual gift that you can gift to anyone, but it always comes out tax-free, but it doesn't impact the exemption, okay? So the money that you give, the money you gift, is always tax-free if you want to help them at some level upwards of $15,000. The second tier is you do have unlimited ability to gift directly to a college, financial or educational institution, or for medical payments. So you can do that as well as a second tier of gifting. This could help your grandkids, this could help a member of the family, whatever, but it could serve a lot of different purposes if you take a look at this area of gifting. The third tier is that big one, the $11.58 million. And our understanding is that there will be, if you take advantage of that now, no clawback when laws change. You'll be grandfathered. And that's certainly no guarantees for any future performance or changes in legislation. but that is our understanding. So it may be part of a consideration if you do have a big estate to take a look at what you want to do at that level. So when it comes to gifting, you have different opportunities available to you, and you may want to take a look at that before the year is out. The final tax planning tip is really important, and it's not just for those who are very wealthy. It's for just about everybody who has a beneficiary associated with their IRA. Because what happened with the Secure Act was they changed the ability to have what we call a stretch IRA. I've been in this business for 32 years. We've talked for many years about the beauty of stretch IRAs. In other words, for non-spousal beneficiaries, oftentimes that's the contingent beneficiary. If I have an IRA, the primary beneficiary is typically the spouse, my wife, and then the contingent beneficiary or the secondary beneficiary would be the kid or kids or grandkids, right? And the stretch IRA was the ability to, with proper planning, stretch the ability for that IRA to be distributed over many, many, many years. That's no longer available, that strategy. For non-spousal beneficiaries, the longest now that they can take out is a 10-year period, and it must be distributed over that 10-year period. So earlier this year, we did a look at every one of our clients' beneficiaries, and we did a review of them, both the primary and the contingent, so that we understood what was happening. And also, when it comes to some estate planning, some people have put trusts as their secondary or contingent beneficiary, and even some their primary. That too is a problem for most trusts now with this new legislation, in that the trust was designed so that they could spread out the distribution of the IRA over many, many years. But now for most trusts, you can no longer do that. So we went back in and talked to most of our clients who had trusts designated and talked to them about possibly making changes. So as I get back to the first tax planning tip, which was the Roth IRA conversions, this may be another reason why you might want to take a look at whether or not it is now the time to convert some of those IRAs to Roths, depending upon what your overall estate planning objectives are. And consider this now. It's an interesting time. Again, tax rates are low. Debt is running up high. We know taxes are going to be increased at some point. We have that sense. Now may be the time to take a look at the IRAs and potentially moving it over to Roths. I'm not telling you you should, or I'm guaranteeing it's the best thing to do. I'm just saying you ought to take a look at it and talk to your tax and financial advisor. I hope these tips have been helpful for you. I hope you've enjoyed this video. Make sure that you look at more of our videos, and I really do hope that you enjoy the retirement journey.